for housing and the future of the American home. I'm Evan Kinne, Senior Vice President here at George Smith Partners. I'm thrilled today to be here with my partner, Ed Steffelin, and our special guest, Ivy Zelman. For those of you who are not familiar with George Smith Partners, we are a national provider of capital market services to the real estate industry, commercial real estate specifically. We customize financing for properties ranging from 5 to 500 million, including debt, equity, and mezzanine financing. Year over year, GSP places approximately $3.5 billion across the capital stack at 200 transactions. During this 1 hour webinar, we'll focus on bringing timely information to you about the housing market. We'll discuss the effects of the legislative agenda on housing, affordability, and what it looks like in the years ahead. Single-family rental, single-family residences, supply, demand, dynamics, and Ivy's new book, Gimme Shelter, which we have here. Hard calls and soft skills from Wall Street. During the last 10 minutes of the call, we'll address any questions that you have. Just don't hesitate to send in questions to the Zoom Q&A feature. It's at the bottom of your screen. Ed?
All right. Well, I am thrilled to introduce someone who doesn't need an introduction. Ivy Zelman, CEO of Zelman Associates. For those who don't know Ivy, she has over 30 years of experience covering housing and housing-related industries. Zelman Associates is a leading housing research and investment banking firm that covers over 44 companies and is pretty active in the investment banking world. Ivy's roots go back to being widely known and respected for her calls on Wall Street as a top analyst. She was a #1 institutional investor, Wall Street analyst for a number of years, and then also a Hall of Famer by Institutional Investor. Ivy has stuck by her convictions, and that has earned her an incredibly loyal following, and she's made controversial calls at many points in the cycles of housing. Today, we'll talk a little bit about Ivy's view relative to others, where I think she may be a little less bullish, but we'll get into that on housing. And I think what we'll also talk about a little bit is, in her book, which I found really, really good, is about her journey as a parent, a mentor, a colleague, a leader, and how that's contributed to her success. And I also am a contributor to her single family rental survey from my build to rent company, Balcar Group. And you can see her leadership style in that, she recognizes pictures of her family, of her friends, of her employees, talks about books, articles, and other stuff to read, in addition to, what she's seeing in research and in housing. So with that very long introduction, Ivy, welcome, and let's get into what we're going to talk about. So last week you were on Mad Money with Kramer, who is always entertaining, and you said build to rent is the prettiest girl at the dance. And Evan and I have closed a number of deals in the build to rent space. We're super active. We've closed them in North Carolina, Florida, Arizona, Texas, you name it. We've been active in that space. So we see how much is going on and how different it is everywhere. It's definitely an interesting sector because build to rent encompasses horizontal apartments, also traditional homes. And so we think it's very interesting. So would you mind giving us a little bit about what you think about this sector and what's driving this new asset class?
Sure. Well, thank you for having me, Ed. And Ed, I already feel really old, so I think we need to clarify. It's not over 30 years.
Sorry.
Nearly 30 years. So I'm an old dog, but you don't have to emphasize that part. But thank you for having me. Well, I would say that, just setting the table for what's happened really since COVID is that the overall residential market has been very, very hot, as we all know. And single family rental has been sort of the new old thing, we call it. And back in 2011, we wrote a report called Leasing the American Dream. And we think that the overall asset class, which has been around a long time, is now going from a mom and pop industry with 15, 16 million households renting to more directly towards an institutional asset class, similar to the multifamily industry that in the mid to late 90s was actually a mom and pop industry that became institutionalized. So we see a lot of parallels, and really we're very, very bullish on SFR overall. What we then started to see, and if you go back to days where Zillow has some pretty comprehensive surveys where they're surveying consumers from all aspects, that one of the things that resonated in one of the surveys, I don't remember if it was 2018, 2019, but they asked consumers, what's the most important to you? What's the most important thing that you're looking for when considering your next home purchase or a place that you want to live, your next shelter? And the answer was they wanted new, and they wanted to be in a community that provided amenity and services. So I think that as we recognize that today, there are many parts of the country that we're seeing a tremendous amount of capital flowing into resi, because resi is the prettiest girl at the dance when you compare other asset classes, whether you're talking office, hospitality, retail, not very attractive. Multifamily is still compelling to investors, but really single family is the hot area to invest. But the consumer wants a brand new home, whether they're owning it and or they're going to rent it. So we're favorable on the concept, and I think it can work. What we're seeing, however, is that there's so much public capital that's been announced over the course of the last 18 to 24 months. For those of you that are probably all too young to know this, especially based, I think it was Evan, who looks very young, holding my book. Thank you, Evan. But there's a movie, you should all watch it, called All the President's Men. I think I may have mentioned it. I stuttered with Jim, but we followed the money. We're following the money that's been at least publicly announced. And there's been roughly 60 billion plus predominantly equity capital that is entering the build for rent space. And part of the reason, to answer your question, Ed, why? Because guess what? Money's free right now, and institutional investors go out and raise money, and they have to pay their investors a return. They expect a return, so they have to invest it somewhere. But what we're seeing right now is that it's so hot, with over half of that capital really geared to a traditional homogeneous single family home that looks very much like the for sale home up the street, is concentration risk. Exponentially high in Phoenix, for example. Of all the starts in Phoenix right now, 20% are built for rent. And that's exponentially higher than any of the other markets that you mentioned. So of the 60 billion capital that's been announced, only about 6 billion is actually in lease up. And then we'll add another, call it 10 billion, that will be up and running within the next several months and will be leased up. So we haven't seen all the capital deployed, but what I am concerned about is the level of inflation that the build for rent operators are having to digest, because land prices have gone through the roof, and the supply chain bottlenecks and the construction issues and the labor shortages. There's massive inflation in the system. So how are you, Ed, going to give your investors the return that you promised them? Are you just going to raise lease rates forever? I mean, I'm at a conference and I'm listening to these guys at cocktail parties talk about they're giddy because they're raising rents on new move-ins in Phoenix 20%. Is there not a ceiling that at some point consumers say, I've had enough? I mean, jokingly, the best way to cure inflation is keep raising prices, because guess what? At some point, the consumer says no. It's like my daughter wants to go on an Uber in New York City and it's rush hour. And she's like, is it okay, Mom? She's almost 17. If I take an Uber, I said, how much is it gonna cost? She's like $100. I said, no, that's what happens. So what I'm concerned about is that there's gonna be all this product that gets developed and brought to the very same markets. And you're going to have a lot of homes that aren't going to get not only to the lease rates that you've underwritten, but to maybe even getting leased up at all. Where are all the bodies going to come from? So I like the product offering. I like the garden style better than the single family, because the homogeneous nature of it is too similar for the for sale product. And I'm going to shut up in a minute and let you ask a question. But when companies tell me they're building workforce housing, I get pretty frustrated with that. Building a single family home for rent that costs $2,100. That's 4 bedrooms and 3 baths. And I can buy the same home up the street 2 miles away. That's exactly the same square footage or close enough, 4 bedrooms, 3 baths, and pay less than that. That's not workforce housing it.
Well, I agree with a lot of what you said, especially, when you go out, since it's a new product and you go out and you say, hey, I need to comp rents. What are we going to charge? You really have to start with what we call chunk rent, right? What is the dollar amount someone can actually afford? And I also agree. I think a lot of people, and especially in the institutional world, have said, well, there's X% of the housing market, we can build this many and we can absorb it. But I think in the United States, there's only so many people that can pay so much for rent. So I 100%, and definitely keeps me up at night in a number of ways. I also would ask you this question is, outside of that, this asset class is not only people who can't afford to own, but it's people who are just kind of renter by choice. Do you think that becomes kind of a permanent slice of like the starter home market? You know what I mean? In the past, you either went to an apartment or you found like kind of a scattered older home to rent. Now you really will have maybe three choices: a multifamily, a detached, or, you know, something else that's professionally managed with amenities. And then you'll have kind of still those older scattered homes. What do you think happens in the future?
Well, with all due respect, I disagree with you. I don't believe that renters by choice are a significant amount of the population that rent a home. I think people that have lacking the down payment, have too much leverage, or have a bad FICO score are more likely to be the permanent renters. Now, you have transitory renters. That's a different story, where you have a young couple that make household income combined is over 150,000. They're moving to an area. They don't know where they want to actually buy a home yet. They want to check things out. They want to rent, and they might even have bought a home and they're waiting for the home to be completed. So there are operators like BB Living in Phoenix that have a more of a move up price point. And I think that transitory renter can afford to buy a home, but you know what, why put your, commit to this major purchase that you're going to hopefully live in for the next 7 to 10 years, utilize a single family rental for that perspective. But I think when you look at Vinebrook, which is a large operator that's building, or they're not building for build for rent, but they're providing a SFR that's under $1,000 a month, like $700-800 a month. Those are renters that have no other alternative. But when you start moving up to the $2,000 a month, $2,200 a month, those people, assumingly at some point, are likely to be for the, call it the near-term perspective. I think they're more of a transitory renter. And what other thing that we disagree wholeheartedly with the market, we're like completely the sober person at the party. Everybody's getting wasted. And by the way, Jay Powell's the bartender, so keep serving it up. But at the end of the day, we do not think that the United States has a housing deficit of 4 to 6 million units. In fact, we just published a report that you probably saw, Cradle to Grave, which I think is quite sobering, about the fact that the US housing market is already overbuilding to normalize demand. And people have like, what? How can that be? Inventories are so tight, lease rates are through the roof, home prices are through the roof. I'll pause and let you ask a question, but that's my view.
Yeah, no, I think this, going to a number of these conferences as well, I feel like there is a lot of enthusiasm. And as we, both lived through the great financial crisis, or whatever you want to call it, the subprime crisis, there are some feelings, where everybody's doing it and it feels pretty bullish. So what do you think happens here that's going to switch that around here, at least on the build to rent perspective? Forget not the aggregate housing. Do you think it just takes a few bad deals to kind of turn things around, or what is your view?
Well, I think, every market is obviously location, depending on where you are. Like, I was chatting with a public CEO, I will not mention his name to embarrass him, but he was telling me that how bullish he was on the build for rent communities that they're doing. And I said, do you know what's on the other 3 corners of the community that you're currently building? He goes, of course we do. I said, well, that's good. I go, do you know what's behind those communities in terms of those corners of next phases and around the market that have yet to put shovel in the ground? And he said, no, please send me that information. So the problem is that the industry is just drinking their own Kool-Aid, that this deficit is so massive that there's an insatiable amount of demand, and that they can continue to build and build and build. And yet what likely will happen is that all of a sudden their traffic and their lease rates are not hitting their targets, and you're going to see pressure on lease rates. That would be sort of the worst case in the near term, is you're going to start to see pressure on overall profitability, on NOI growth. But I think more concerning, and again, you only have, call it 20% of the capital has actually been allocated of the 60+ billion, which again is just predominantly equity capital. That gravy train of capital continues to come. So the more and more construction that comes to fruition, then you get into a scenario, if we're right, and household growth, which is the slowest it's been in the United States history through this past decade, if we just don't have the physical bodies, then you're gonna have a lot of BFR broken deals. You're gonna have operators that have too much leverage, and you're gonna have companies that go belly up. And then there'll be great distressed opportunities, because you're gonna listen to me, Ed, and you're gonna go buy those.
That's right. It reminds me of a very bad joke I have, which is, why did the chicken cross the road in Phoenix? To
Wow.
get to the competing SFR community.
There you go. I like that. I like it. It's good.
Actually, I have a kind of a follow-up question back on the kind of the renter by choice conversation we were just having. I was just recently at a conference, I think a week or two ago, another research firm was pitching there on kind of this total, I would say, just the opposite argument of what you just gave, Ivy. And he said that there are around 3 million baby followers. These are baby boomers taking retirement early, leaving the labor force, and now they're following their grandkids. They're moving to Phoenix and all these other markets and renting for a short period of time, or maybe forever. They don't know. Is that something that you've looked into? And do you see that that shift in the labor force affecting the build to rent space at all?
I think it's a viable thought process. So we haven't done work on it, but I can tell you that when you think about, renters by choice in general and what millennials are in fact looking for on the younger sort of where mobility comes from, when you have boomers downsizing incrementally, that could help support more lease ups. But the real meat of the market needs to be supported by incremental household growth. And the one thing I would tell you is that the ability to build wealth over a long period of time comes from actually owning a home, which is through forced savings. You're paying a 30-year fixed mortgage rate, assumingly building equity. And for those people that are renting by choice, they're not going to be able to create wealth over a long period of time. Plus, they have a variable expense. Every year, their landlord can raise their rent. So United States, unlike other countries, there's a few out there that actually have forced savings. The US doesn't, but the mortgage market through mortgage financing of home ownership actually creates wealth over a long period of time and reduces that inequality gap. So I can't comment. I haven't done the work on how many boomers are returning to areas to live near their grandchildren. We know that the mobility rate, so being in that older category, when you're 20 to 24 in the United States, the number of households that move in a given year between the age of 20 and 24 is over 53%. When you get to my age, 9% move in a given year. By the time you're in your 70s, 5% move in a given year. So you're talking about the numbers and the trajectory of an aging population are generally immobile, especially if rates were to go up. So right now, 2/3 of homeowners in the United States actually have a mortgage rate below 4%. So do you think the boomers or this generation is going to sell their home, possibly take all the equity and then go rent a home because they want to live near their grandchildren in Phoenix? Absolutely, that's a possibility. But when you look at the absolute numbers of how many people are in that category and what's going to drive all of this incremental development, I think it's probably pales in comparison of what you need to really get to the return requirements that a lot of these developers are underwriting.
Okay, and one more follow-up. Well, I do think some of those people are going to sell their homes and buy crypto, but that's a whole nother story. What do you think the pressure? So have all this build for rent being constructed or planned or financed. How do you think of that in the lens of multifamily? Like, do you think that ultimately has an effect on supply? And even if build to rent's forced to cut prices to compete with multi, what do you think about that?
Well, we actually have something called a GDI index that we created. And the easiest way to explain it, we love scale 0 to 100. 0 is in the hinterlands, and where the cows don't even want to live, my joke is, versus 100 is being in New York City in a dense market. And we can look on every build for rent project that we actually were following that was publicly announced. Where is it located? And I would say the lion's share of it is in 0 to 4. So everyone's building very far out in the sort of the rings. And they're doing so because that's the only way you can pencil a return on what land costs. So they're going way out there for the majority of them. And what likely will happen, I think, is that you're dealing with markets that, because of that competitive nature, the multifamily is not going that far out. So had Starwood, the head of Starwood from the multifamily division, that basically says we don't compete with build for rent. So dependent upon if you're garden style apartments, if you're out near that sort of third ring, it can be a competitive challenge. But for the most part, I'd say multifamily is like the majority is going to be in the GDI that's significantly higher, maybe 40, 50, and that's even in suburbia. So, you have to go more to extremely suburban to really see people willing to drive that much further out to leave the multifamily, call it a garden apartment or a high rise that would look to that lease rate out in the tertiary that they would find compelling.
Got it. So in this, 60 billion of capital creating a tremendous amount of supply, and you're talking about just too much supply driving down rents. What's the tipping point with that in your mind? Or is there one, or is it too hard to predict?
I think it has a lot to do with cost of capital. If you look at right now, if you were to look at what funds are, how many institutions are raising funds, if you follow their fundraising, you'll be able to determine when the tipping point starts to come to fruition one way, but just rates, the cost of capital starts rising. It's going to be even harder to pencil those returns. We are seeing demand starting to moderate within the for sale market, where consumers are really starting to question whether they've missed it. We're seeing buyer fatigue. We're starting to see pressure on overall profitability from suppliers that can't hit their returns just because the inflation in the actual building products. So I think what you have is one of my operators in Dallas who does for sale is like, look, we see already some broken land deals from BFR guys that just are not penciling their returns, and they're literally like walking away. And that's only an anecdote or two. But I think that it comes about, take Dallas as an example. You got 75 production home builders there, and land prices are up well north of 30 to 40% on average in the United States, just across the US. So I think it's about not hitting your returns. And at some point, the consumer says, I've had enough. I'm not paying that higher lease rate. You also have a lot of SFR and less so built for rent, but let's just say the competitive product offering that has physical occupancy as opposed to economic occupancy. So maybe we'll never, I'm quite cynical about our government and our local governments, maybe we'll never have evictions and we'll just have eviction moratoriums forever. But we know that that's giving the benefit to upward pricing power by having many units that are not available to lease. So if you start to have evictions, there's about 1 million people that aren't paying their rent in the United States. So how many of those are living in single family rental versus multifamily? You can argue it's more disproportionate to multi than to SFR. But I do think that the tipping point comes when it relates to evictions coming to fruition and cost of capital overall rates.
Yeah, and I think one of the things to point out too is if you look at the securitization markets, single family rental, the people who own the scattered or even increasingly built to rent communities that can access securitization and scale, you're at sub 2% rates, for 10 years is super attractive financing today. And as we know, I think financing has often caused some of these issues if we look back in time. So
we hear too, Ed, that there's many like high net worth country club type, debt funds that are going out and raising money to the high net worth investors, not really levered, but call it, 65, 70% LTV. They then get all of the capital they raise, and then they promise them these massive returns. So I think at some point investors say, hey, where's the return you promised me? I mean, I was actually yesterday at a major, 2 trillion AUM funds, or whatever we want to call them, let's call it large institution. And they promise on these hybrid investments they're making that they can deliver an unlevered 10% return. I said, can I invest with you? Because that's like, where the hell are you getting that? So, but investors will demand their returns. And as cost of capital rises and demand moderates, I think there's going to be disappointments that come to fruition on what investors' expectations, where investors' expectations are.
Got it. Let's talk about the legislative agenda on housing, both at a national level, and our firm is based in Los Angeles. I'm out of the office today. Looks like
Very
you're
nice.
traveling. Ed's traveling. What's that?
It's a very nice backdrop there.
Yeah, Boise, Idaho. Beautiful here. So, are there any big concerns that you have politically? You mentioned the 1 million renters who are not paying rent in our country today. I mean, what other concerns do you have? I don't know how familiar you are with California, but California is trying to figure out ways to cram housing into more urban areas. Let's try to shift gears here a little bit and talk about a different area. I don't know where to start exactly, but let's start on the national level.
I think at a national level, the administration has got, so many problems. I mean, I don't even know where to start. So housing, they recognize right now, they're trying to figure out how to get the Long Beach and LA ports from being backlogged because they don't have enough truckers to unload, get the ocean freights to port. So that's like a near term problem that they're focused on, a big one. But I think more broadly, the Biden administration would like to reduce the inequality gap and have more non-Caucasians where home ownership is pressured. They want people to be able to buy homes, and their focus is to, whether it's tax credits or sometimes whatever it might be, some type of buyer down payment assistance. That's one initiative. Reducing FHA premiums, possibly that might help home ownership, or people mitigating investors' ability to have sort of the first purchase. Remember with the foreclosure crisis where Fannie Freddie put a moratorium on investors buying foreclosures, and it had to be a primary buyer that has a first look. We've heard that those are things that are being discussed. There's a lot of backlash for all the institutional capital that's coming into the space and trying to understand exactly, are they taking away the American dream from the prospective homeowners? So I don't think that the administration really has a good answer for that right now. But one of the other things that they're talking about is zoning, that they want to improve zoning regulation, and they really can't do much at the federal level. It really is at the local municipality level. And like what we're seeing in California, what you mentioned too on density, that's a joke. Okay. That's like taking, what today is a 2 million, a home that's $1 million to 2 million, that might be a little ranch that was built in the 60s. Yeah. And that person will sell their house, and now we'll build two $5 million houses on the same lot. How is that affordable housing? It's ridiculous, really. I think it's so stupid. Plus the homeowner has to live there for a period of time before they can actually move in order for it to be part of that opportunity. So not knowing a lot about that, the SB 9, I think that's what the bill is called, but I would just say that seems like a real, not a real solution.
Not heavy hitting. It's not going to change the game.
It's nothing to do with affordable housing. It's nothing to do with.
I think we agree with you. What about taxation? There's just been a lot of talk lately about, maybe the elimination of 1031. Sounds like that's not going to happen, at least right now. Maybe some different capital gains taxes, carried interest, et cetera. These are other challenges or changes, I guess, in the greater system that could potentially affect our clients. Remember, our clients are developers primarily of real estate, multifamily, built to rent, anything, office, et cetera. How do you see that impacting over the medium term?
Well, I mean, we have to pay our bills somehow, right? I mean, we're in massive deficit. We would expect that tax rates across every aspect of taxation will go higher. Right now, we have a debt ceiling. They just kicked the can down the road to December. I think that the near-term problems, the Fed has to start tapering because the party continues and they continue to, keep rates artificially low. I mean, why the hell is the Fed buying 40 billion of MBS every month? It's the most ridiculous thing in the world when home prices are up at 20% year over year. It's crazy. So they have to tax us. They have to do higher capital gains tax. Could they pass a 1031B exchange elimination? I don't think they can get anything done, Evan. I'm so cynical. Both sides of the aisle are messed up and they can't agree. We have legislators that are 80 years old, for God's sakes. I mean, these people cannot figure out a way to compromise on anything. So yes, right. I'm cynical. But I know they're going to raise taxes, and I know that we're going to see more people that live in cities like New York and California that are going to contemplate moving to areas where taxes are at a lower basis. But as a developer goes, that's one of the reasons why developers want to build in low-cost states, because they're worried that, the benefit of migration. But like take California, for example, the great state of California. You say you're from LA or you live in LA?
Yeah. Mm-hmm.
Okay, but you're in Boise, so you confuse me. Okay, so when you look at LA and you look at San Francisco and the number of people that left the coastal market to go inland during COVID, the idea was that everybody left the state of California. They just migrated to Boise, they went to Austin, they left the great state of California. If you look at actual post office data for request address changes, 0.3% left the state. And that's roughly 70,000 households. So a lot of people will talk about the migration that will benefit your developers in many other cities. That's been the case. When you look at household growth across the nation varies considerably. You can look at a state like Ohio, where household growth is running 2 to 3% versus Boise that is growing double digits, but it doesn't necessarily mean that is sustainable at those levels. So it's like this mass migration is going to solve everything. But I do think that taxes are going higher, and I do think it's going to challenge the developers that are in markets where there's obviously a much higher tax cost basis.
I agree with you, Ivy, and I live in New York City, so I felt the full brunt of the the SALT tax issues. So hopefully we'll be
More
able
to come.
Sorry?
With more to come.
I know. Well, it reminds me of the old Ronald Reagan quote, what's the scariest phrase in the English language, right? I'm here from the government and I'm here to help. With that though, I guess with all the budget and, congressional gridlock and, Jerome Powell now getting attacked a little bit, what do you think mortgage rates? I mean, obviously it's a huge variable and we've seen 8 or 10 bip tick up recently. I think they're right around 3.2% roughly. Any thoughts or view on which way mortgage rates are moving?
Well, we don't forecast mortgage rates, but I can say that what we have really a better understanding of is really what mortgage spreads are doing. So when you look at MBS, and basically is an inverse relationship between mortgage-backed security prices and rates. So as you have less demand for MBS, you will have yields go higher. So if the Fed is going to pull back even marginally, they're propping up the mortgage market. That's why rates are artificially low, because the Fed is buying. They are incrementally adding demand at 40 billion a month. So in our view, if they start tapering as they're supposed to, with the governors all saying they're going to start in November, we'll see rates move higher. Now, incrementally, if you look at the for sale market today, just like for lease, you're seeing monthly payments are rising. So by the end of the year, right now, we're on track for getting rates going higher, for a 20% increase in the monthly payment to the consumer. That matters. And what happened in 18, just to refresh you, in 18, the housing market came to a screeching halt because mortgage rates went from 4 to 5%. And everybody's like, how can the housing market slow at 5%? Well, part of it is that the great refi boom that we enjoyed for the past 30 years, or rates just on a downward trajectory, people get locked in at low rates, they're disincentivized to move. So you have the 3 Ds of real estate. Can you give me 1 D, meaning you have 3 Ds that you'll always have a transaction? Give me 1 D, Ed.
Down payment.
Nope, you have a transaction. One more chance.
Oh, debt to income.
Just 3 reasons that people are always going to transact no matter what. You have death,
divorce, and debt.
default. Death, divorce, default. But you have a 4th D. I actually had a client it was a good one. He said diapers, but I didn't have diapers. It's one of my. But you have.
I'm in that stage right now. So
you're a diaper one. There you go.
Yeah.
Diapers is a big catalyst for transaction, but usually two diapers as opposed to 1. 84% of married couples are cohabitating that have 2+ children. 84% live in a single family home, not necessarily own, but 84%, which is pretty high. For diapers will drive home ownership or rental, single family. But more importantly, Ed, going back to your question, I think that you have transactions that always are going to occur. But when you have discretionary transactions, if rates were to go as little as the 3.5%, if you went to 3.5%, that is going to disincentivize all those people that are locked in below 3.5%. And that's what happened in 2018. So in 2018, when the market slowed, more than 2/3 of homeowners had a mortgage rate below 5%. So now we're in a situation where 54% of homeowners have a mortgage rate below 3.75%. So this is the backlash. As rates start to rise, it immobilizes. Or is that a word?
Yeah.
Right? We keep people stay put in their homes. Now, for you or the affluent, the 1% that say, I'm going to uproot my family, I'm going to leave my house and go move to Florida from New York because it's a better tax basis. Not everybody could do that. So I think that the idea that we're not going to have an impact from higher rates, or people are going to just find a lower cost alternative, there's not low cost alternatives out there that much. I mean, it's been a very interesting market to see what has been, in my opinion, a massive amount of free capital that has incentivized people to have a multiple number of homes. So for example, if you talk to New Yorkers, like the people I was with yesterday, I say, how many homes do you have? Everyone in the room I asked, I would say the majority had 2 or 3 homes. Now, these are affluent people. They're not all that affluent, but some of them have their apartment in the city that they rent and their lease wasn't up. So they wanted to get out of the city. So they went to one of the part of the tri-state area and they bought a home. Or they might even have a second home in Florida, but they don't really want to go all the way to Florida because what happens if their boss wants them and they have to come to the office? So they want to they have their vacation home, they have their co-primary home, and they still have their apartment in the city. Maybe they'll sell them. But there's multiple dual residencies by many. It's all free capital. So rates going up marginally every time rates tick higher, and the Fed is going to have to stop buying all the MBS they're buying. Rates are going to go up and the market's going to slow. And it might not go up that much. I mean, mortgage rates, we have right now so much inflation. I mean, I wouldn't want to be Jay Powell. I wouldn't want to be anyone on the board of governors. I think they have a hell of a job in front of them because we have significant inflation. And you know what? Everybody says, well, it's transitory. Well, the inflation in the 1970s was transitory too. Transitory definition in the Oxford Dictionary, transitory is not permanent.
All right, let's.
I think you're right.
Go ahead. Go ahead,
Evan.
No, go ahead. Ed, finish the thought.
I was just going to say, I think you're right. So not only do you say if mortgage rates tick up a little bit, obviously that's going to hit people's monthly payments for people who purchase, and you have inflation, which is going to hit everybody's income, right? I mean, 5% inflation it's a pretty big hit for folks who spend a lot of money on everyday goods. So I think that's definitely something to consider.
Get into one of the CEOs, I won't mention their name. I said, so on a conference call, I said, so do you not agree that there's a ceiling for renters at some point or homeowners? Affordability doesn't matter. You just can keep raising prices or lease rates indefinitely. And their answer was, so basically pricing is inelastic, demand is inelastic. And the answer was, well, they'll just spend more of their discretionary income. They'll reallocate it back to their non-discretionary shelter. And I'm just kind of shaking my head, like they have no choice. But what people don't realize is multi-generational living is accelerating at a pretty robust pace. And that's really a function of the lack of affordability and also ethnicity. So when you have the white Caucasian is going to become the minority, and you have Asians and Hispanics and people of color live multi-generational, and Europeans. I mean, you ever been into, anyone in Europe? That's the direction we're going in, but yet we're building enough houses that our household growth is the same that it's been since the 1970s. Forget just rates. There's a lot of potential risk if we do not recognize right now as individual developers and operators that don't play in the same sandbox as everybody else. Go to the markets where no one else is. You can be successful, but if you're all on the same kind of, the sheep mentality that we all want to be in Phoenix, rents are going to be the same in Phoenix as they are in San Francisco in the next year or two. Maybe not two. Right.
All right, let's switch gears a little bit. You recently wrote a book. I was able to grab a copy when it came out, and
thank you.
Yeah, it's very good. I'd recommend it to everyone. It's interesting because you get to read about some of the soft skills and whatnot. Obviously, you're have a very interesting career, and it's kind of an inspiring book. A couple of times in the book, to shift gears here to more of a personal level, you talk about kind of sticking to your guns when everyone doubted you. Talk about in August 2000, I can't remember what the exact situation was, but you kind of betted against Buffett. And then again, obviously, in 2006, obviously you had very strong opinions then. It turned out to be right. Let's talk about, what you do personally to maintain that, going against the grain. It's kind of an admirable trait.
Thank you. Thank you for recognizing that. I think it has a lot to do with having people like Ed, the C-suite executives, owners, and operators that are feeding the information. So in 2005 or 6, I'll go to Buffett in a moment, we probably had only a few hundred companies at that time that we were exchanging information with confidentially. And having them tell me, this is nuts, Ivy, you would not believe the amount of land that what they're paying for land, or the fact that they're selling this much to investors. We take what we aggregate from our proprietary industry contacts in addition to the proprietary data aggregation that we have. And you just Fortunately, I can get on the phone and call a CEO and say, am I going nuts? I mean, the market just keeps going up. They're like, Ivy, I'm telling you, I'll give you an example, buying a piece of land and it's a beauty contest and everybody around is, putting in bids. There is no way that I can pencil the return that I need to justify the land purchase. So I call up this guy who used to work for me and he's like, how did you pay for that land? It's ridiculous. He's like, if I don't buy that land, I won't have a job. So I have to keep feeding the machine because we have to keep showing revenue growth. So conversations like that, Evan, really helped ground me. Even though I went home and cried on the couch a few times because being wrong is not fun. They called me jihad, poison ivy. Everyone hated me. They had voodoo dolls with ivy pictures on them. It's not easy, but when through really the collaboration of the data aggregation married to boots on the ground, real owners and operators that are telling us the insanity that we were witnessing, we couldn't do anything but stick to our guns. And it wasn't just me, it was my team. So, I'm very fortunate to have Dennis McGill, my co-founder, who's been with me since he was a summer intern at Michigan, 21 years. A lot of the people that I work with, the collaborative way that we operate. The Buffett one is more of a, fortunately, it was kind of funny story because Owens Corning, I covered USG, Owens Corning, all the big Armstrong asbestos companies that were on the hot seat. And one of Owens Corning's head of chief legal brought me to dinner in New York with this guy who's considered special master of asbestos, and same company that did 9/11, that did the BP spill. And he was, there to convince me not to worry. Well, this guy became the hook that introduced me to all of these prosecuting attorneys and all these class action guys that are getting cases. They're like, no way in hell. And he just gave me 25 different prosecuting attorneys to talk to. So that I was like, there's no way that these guys are ever going to settle, because I was talking to them. And then when I was home on maternity leave, and all of a sudden Buffett already had a significant amount of debt that they owned, USG bonds. I guess he bought a big equity stake, and I was home on maternity leave and I'm getting my phones blowing up and he's buying the stock, and all my sales force is totally doubting me. And they're like, I can't believe that, what you need to upgrade the stock. And just call a few of those prosecuting attorneys, call my asbestos friends, and they're like, stick to your guns, Ivy. So it's the people, it's the networking. And every time, my husband always jokes, you like meeting new industry executives more than new jewelry. And I can assure you that's not the case. Okay. I love jewelry as much as meeting new industry executives, but it's the people, through networking and owners and operators and data. Long-winded answer, but anyway.
No, that's great. Let's talk a little bit about, encouraging more women to enter finance, and we're in the real estate finance business. What advice do you have, and what can you recommend to both business owners to attract more women, and then also maybe younger women who might be listening to this?
Well, the good news is that more women are pursuing a higher education. The numbers for women for ages 20 to 34, I think, are now at 46% complete a four-year degree. Men are going the wrong way in terms of the ones that are completing that four-year degree. So there's going to be more of a pool of women in the marketplace looking. I think that finance is intimidating to a lot of women because they know it's kind of more male-dominated industry, but so is like housing. I mean, housing is just as bad in many respects. I'd love to get more resumes in the door that are women, or any candidate. We just don't see enough of them. But when we get them, it's like they're not assertive enough. They're not willing to ask for help. They're not willing to be bold. And I think you have to be able to be in the boys' club. You got to go and be able to in the locker room. You got to be able to swear. Probably won't say it on bad words on this call, but people used to call me a bitch, as opposed to, I'd say, well, I'm just assertive. So I think you have to be able to raise your hand and ask questions, and you have to be not intimidated on what people are going to think about you, and ask for help. Women need to ask for help. How do you attract that level of, persona? I don't know, but I don't even know a lot of men that way. I mean, a lot of men they don't have the tenacity or grit to really go after it. But when women are around men that do, a lot of them are intimidated. They just have to buck up and thick skin and go for it. And, why do you want to be in finance? I wanted to be in finance because I want to make a lot of money. And that was all about for me, was making money. And nobody was going to stop me.
So we're going to switch gears now to some Q&A. But before we do that, you just recently, sold your company to Walker and Dunlop. Let's talk about this exciting new chapter. And then I have a bunch of questions here rolling in through text and also through the Q&A thing here in Zoom. I encourage everyone to shoot in some questions here. And so, but yeah, while we switch gears, let's talk about your company.
Well, I've known Willie for, probably about a decade. He actually presented at one of my housing conferences back in 2012 or 13. So we've been friends for a long time. And he asked me to go on the Walker webcast that he now started in, I think, early March of 20. And I did the webcast for him in August of 20, and it kind of blew up my website. A lot of interested leads that we could convert. And I thought, I've got 4 salespeople. I don't have the technology and or the sales marketing budget to really go after this wider net, this larger TAM. So let me call Willie and say, hey, what do you think we do like a joint venture? And one thing led to the other. They don't have research. He's looking for maybe doing in-house research. They don't have investment banking. They do a lot of deals, investment sales, commercial lending, and they watch other people get fees for investment banking when they're right there in the middle of it. So it was really just a great fit. And culturally, we really clicked, even though it's a large organization compared to our 25-person organization. I think the cultural aspect of the way Willie runs it, is still very entrepreneurial. So I think so far, so good. We're having fun.
Great.
And I think a lot of synergies and strategic opportunities.
Well, congratulations. So we're getting some questions in here. The first one is, what is an appropriate investor expectation for 5, 7, and 10-year holds? I think they're talking about, given all of the changes that we're talking about on this call, like how would you think about holding if you're buying right now? Or what would you plan on? I think that's the question.
I think that returns historically have been sort of low double-digit levered returns. That would be sort of a buy and hold 5, 7-year type expectation. I think you got to haircut that, and you're probably in the mid-single digits if I'm right, and the market starts to, and maybe you'll see some negative returns, but if you stay with it and you get through a correction, the problem is everybody says they're long-term investors, but when the shit hits the fan, nobody's a long-term investor. I can tell you that right now. That everybody wants their money back. So, it's really about local markets and knowing the competitive landscape. But I would probably say mid-single digit to high single digit returns is what you should expect on a levered basis.
That's interesting. Let's see. I'm looking through the rest of the questions here.
Evan, maybe one on, hey,
Yeah.
Ivy, one of the interesting things in home building is, they're often criticized for building homes the same way they did 100 years ago. So there's all kinds of technology, smart home, offsite. And what, you have any thoughts? And that even goes into the mortgage world, right? In terms of title insurance, all that stuff. There's so much money piling into that. Do you have a view on how much technology is going to change the home building space?
Well, I have a lot to say about that. I think there's a lot of good innovation, technological platforms that are providing a more delightful experience to the consumer. And I think that those are aspects that will continue to drive more capital to pursue, a dinosaur asset class. But the actual construction of homes, no, I am not optimistic. You might have some 3D printed homes, you might have some one-off little niche players, but I do not think that manufactured housing, mobile homes, factory built homes will come to fruition in any significant way. It's a really tough puzzle to put together if you've ever built homes, and every aspect of it, you don't want your eggs in one basket. You don't want to have just one vendor that you're dependent upon. The trades right now, the labor shortages are legitimate. You see a lot more floor trusses, roof trusses, panelization. There are aspects of the construction process that are and have been improving for a long time, but the actual sea change that we're going to have the ability to produce automated homes being built, I don't think that will come to fruition. But there are a lot of startups and there are a lot of capital or platforms with significant capital backing that are trying to provide liquidity to the housing market, because you get a lot of cash poor people that are house rich. And what can you do? I want to sell my house, but I don't have a house to move into. So you have the iBuyer market, you've got bridge financing now, but these guys are velocity guys. So what the likelihood be is that, let's say that you buy a house, somebody buys your house from you in 3 days. and you pay a little bit more for that liquidity, and they provide you a bridge loan. So you can go buy your house with cash, backstop your house. That works really good in a seller's market. What happens when you're in a buyer's market? So I asked them, I said, what are you going to do with the house that you backstopped that now is actually going, it's below the price you paid for it? They go, we're going to blow it out. We're not going to hold it. So you get all these guys that are fast turning. It's all about the velocity. And I think those are maybe going to create more volatility in the housing market in the zip codes that they're prevalent. But that's the technology piece of it that a lot of people are pursuing. But like the smart homes, when you walk in your home and you can have facial ID, or, you go into an apartment building and no one can get in without having facial ID or a code that you've given them, or they can have their elite detection technology. Smart Rent is a great example of a platform that I think is phenomenal. Just full disclosure, I own the stock. I personally invested in it. I think it's the direction that will improve consumers' lifestyle. So there's a lot of good things, but I know you got more questions, so let me stop there. Maybe you don't.
No, go ahead, Evan.
Oh, yes. A couple of questions came in on wage inflation, and kind of the effects on affordability. It's interesting anecdote. The Wall Street Journal, I think it was yesterday or this morning, had an article on, all of these companies now trying to compete with Amazon because Amazon can just pay more, and Amazon's going to try to hire, 300,000 people in the next, year or two. It's just unbelievable. Let's talk about wage inflation and what will that do to near-term affordability?
Well, I think we need more wage inflation because of all the inflation we've seen in the shelter and asset class for both rental and for home ownership. But I do think that today it's an extremely competitive market. I'm sure you've heard the expression, the great resignation. Everybody job quitters, people leaving their current job is just skyrocketing. I don't know where they're all going, but they're moving to Boise or getting a ranch or not a ranch, an RV, and they're just going to travel the world, and COVID's changed how they think about life. But, you try to find someone who's willing to be a trucker. It's a terrible job. And, today you have truckers getting paid $30, $40 an hour. So if you want to go sleep in your truck and drive an 18-wheeler, there's lots of wage inflation there.
It's a great time to be an Uber driver, right? I mean, I was like in San Francisco the other day, and I think it was like $60 just to go for probably 15 minutes, it's just out of control. So.
Well, I think the wage inflation in certain industries, you see substantial wage inflation. And then in other industries, like in hospitality, in restaurants, you can't even find the bodies. In Boise, in Jackson Hole, literally, you can't get a car service. Like I went to Boise, I went to Sun Valley in July for Walker Dunlop's annual conference. And they were like, well, you have to go on the bus because if your flight doesn't arrive, there's not enough drivers to come pick you up. I'm like, what? And my business partner, Dennis, took his 4 kids, 10, under 10, crazy, to Jackson Hole. And their whitewater tour guide was living in his van. And he was explaining that, and the restaurants were closed half the time because they didn't have enough workers. So forget the wage inflation. They don't have the physical bodies to employ in certain industries.
Very strange.
Yeah. Strange times we're in.
Yeah. So Ed, do you have any on your end, or we can, there's a couple more here, but let's wrap it up here with a couple of fun questions. We'll just do 2 questions, I think, here. We'll be out of time. So a lot of questions are coming about Florida. We've kind of talked about that and about, build to rent market, the boomers, all that stuff. So let's talk about, give us a number one, one more funny story from your career or from your book. You talked about your son giving out business cards or something like that. And then let's wrap it up with what keeps you up at night right now.
Well, I don't know if you want me to talk about my children, because that's always fun for me. I don't know if it'll be fun for everybody, but, I think as a parent, as a working parent, men or a woman, that, for me, I talk to my kids when they were, 10 as if they're 40, and I remember my son and I went hiking in Aspen, and I don't know, we just started talking about whatever. I mean, he knows all about my employees and who's performing and who's not. I once had my daughter walking around the office and she was looking over the shoulder of the sales guys and she's like, Mom, Jim Yazbek is on ESPN and he's not working. And I was like, are you kidding me? I'm like, what the hell? So, and I didn't tell her to do it, but she kind of knows, like she's got this little grid herself. Or my son, where he's eating leftovers. I might have written this in the book. And he looks at his father, he's like, I don't want to eat this. And he might be like 12. And my husband's like, I don't really give a shit. You're going to eat this. And he's like, it's a sunk cost, Dad. And my husband looked at him and he's like, how do you know that? And he's
That's
like,
hilarious.
Mom taught me.
Actually, I'm going to throw in one more question before what keeps you up at night. This is a good one. Let's talk about like innovation in home building. So different types of home manufacturing, 3D printing, all these things that right now are kind of more expensive, but have maybe potential to solve some supply chain issues. Anything there on the labor and supply chain, or is that a pipe dream?
I don't know, pipe dream. I think it's a dinosaur industry, and many of the industry participants just are not willing to look at a return on investment. They look about absolute dollars of profits. So it costs more to go down that direction for factory built and to mitigate human capital. It's a lot better from a velocity and from a return perspective, but they don't see it that way. So it's going to be a very long haul. So I don't really see anything near term coming to fruition.
Got it.
So it
All
keeps
right.
me up at night. I got a long list,
Yeah.
Evan. I don't know about you.
Not
but
with your kids, not with your kids in the business world.
The business world? Okay. In the business world, I worry that we're going to have a severe equity market correction, and I'm too long equities. So that's what I worry about, because I really think the country right now is screwed. And I feel like we have been on this binge where we're benefiting from massive amount of debt, and we have too much free money that can't continue, and we're going to have to pay it back with higher taxes, and rates are going to go higher. So I worry about an equity market correction and what that's going to do and the ramifications of what it means to, wealth in the United States. But I'm a worrier, Ed. I worry for a living. That's what I do. So don't ask me. I'm still long too much. I'm not going to sell all my equities, but I'd like to, put myself a little bit more in a higher percent of cash.
Yeah.
Cool. So where can people find out about you if they want to make sure they're staying up to date with your information?
ZelmanAssociates.com. And you can always reach out to Kim at ZelmanAssociates.com, who is my right, left, and every body part, Kim Gray. But I really appreciate this. Was fun. I hope I knew I swore, so I hope I apologize for bad language.
Okay.
And Evan, what's the story with the diapers? Is this your first, second?
No, we have 2 kids,
Oh,
but still one in diapers. So busy. And my wife was texting me on this thing because she was like, this lady's awesome, because my wife is also a career person. And so
Go girl.
it's always
Kick
great.
your
Yeah,
husband's butt. That's what I tell you.
that's what she does. So
There you go.
she keeps me in line.
That's great.
All right. Well, thank you. Just as we close here, I'm supposed to make sure everyone signs up for our FinFacts newsletter. You can follow us on LinkedIn, Twitter, and on YouTube. So thanks to everyone for joining today.
Thanks, guys.
Thank you, Ivy.
A lot of fun.
Thank you, Ivy.